In January 1999, during Super Bowl 34, a commercial featuring a simple sock puppet captured the imagination of millions of Americans. It was the mascot for Pets.com, a startup promising to revolutionize how we bought dog food and cat litter. At the time, the company had almost no revenue and a business model that lost money on every single delivery. Yet, within weeks of that advertisement, the company went public on the NASDAQ, raising $82 million from investors eager to own a piece of the future. Less than a year later, the company was liquidated, the sock puppet was sold off, and $300 million of investor capital had vanished into thin air. This was not an isolated failure. It was the definitive symbol of the dot-com bubble, a period of collective financial insanity that saw $5 trillion in market wealth, created out of nothing and destroyed in a matter of months. We often think of the internet as the ultimate success story of the modern age, but for those who lived through the turn of the millennium, it was the site of the most spectacular economic collapse since the Great Depression. To understand how the world's most sophisticated investors lost their minds and their money, we have to look back at a time when the old rules of economics were declared dead and a new digital gold rush took their place. Stay until the end to find out how the lessons learned from this $5 trillion disaster are being ignored today by a new generation of speculators. The mid-1990s were characterized by a sense of profound optimism and technological triumph. The Cold War had ended, inflation was low, and the United States was experiencing one of its longest periods of economic expansion in history. At the center of this growth was a transformative new technology called the World Wide Web. When Netscape, the maker of the first popular web browser, went public in August 1995, it changed the financial world forever. Despite being a young company that had never turned a profit, Netscape's stock price soared from $28 to $75 on its first day of trading. This event signaled to Wall Street that the internet was not just a tool for academics and hobbyists, it was a fountain of unlimited wealth. Suddenly, every traditional business felt obsolete. The Federal Reserve, led by Alan Greenspan, maintained relatively low interest rates, which provided a surplus of cheap capital that needed a home. Venture capital firms in Silicon Valley began pouring billions into any company with a .com suffix. The narrative was simple. The internet changed everything. In this new economy, the traditional metrics used to value companies, such as price-to-earnings ratios, net income, or even revenue, were dismissed as relics of the industrial past. The players in this drama were not just tech geniuses, but also retail investors, many of whom were using the newly developed online trading platforms to gamble their life savings on stocks they barely understood. By 1997, the economic problem was becoming clear to those who cared to look at the data. The market was no longer valuing companies based on what they earned, but on how many eyeballs they could attract. This shift from profits to traffic was the fundamental trigger for the bubble. If a website had a high number of visitors or clicks, it was deemed successful, regardless of whether those visitors ever spent a cent. This led to a desperate race for market share, where startups spent more on marketing than they could ever hope to recover. In 1999 alone, 368 companies went public, and on their first day of trading, these stocks rose an average of 65%. The risk was enormous, yet the fear of missing out, or FOMO, overpowered any rational sense of danger. Investment banks, which are supposed to act as gatekeepers, began competing fiercely to take these unprofitable companies public, often receiving massive fees and shares in return. Even Alan Greenspan, the chairman of the Federal Reserve, grew concerned, famously using the phrase irrational exuberance in a 1996 speech to describe the rising stock prices. However, despite his warning, the Fed did little to tighten the money supply for several years, allowing the bubble to expand until the NASDAQ Composite Index reached its dizzying peak of 5,048 in March of the year 2000. The mechanics of the crash were as systematic as the rise. To understand why the bubble burst, we must look at the cycle of venture capital and the reliance on public markets for survival. Most dot-com companies were burning through cash at an unsustainable rate. They relied on a continuous cycle of funding rounds to pay for their massive overhead and advertising budgets. When the Federal Reserve finally began raising interest rates in early 2000 to combat inflation, the era of cheap money came to a sudden halt. Simultaneously, many of the early internet companies reached the end of their lockup periods, allowing insiders and early investors to sell their shares for the first time. As they began to cash out, the market was flooded with supply. The turning point arrived in the spring of 2000 when a lead article in Barron's titled "Burning Up" revealed that dozens of top internet firms were months away from running out of cash completely. Panic set in. Investors who had bought at the top realized that the new economy was subject to the same laws of gravity as the old one. Between March 2000 and October 2002, the Nasdaq lost 78% of its value. For individual companies, the numbers were even more staggering. Webvan, an online grocery delivery service that had raised nearly $400 million in its IPO and built a billion-dollar infrastructure, filed for bankruptcy in 2001. It had burned through $1.2 billion in less than 3 years. eToys, which was once valued higher than the legacy retailer Toys R Us, saw its stock crash from $84 to pennies. The analysis of the fallout shows a global economy in shock. The wealth effect, where consumers spend more because they feel rich from their stock portfolios, reversed violently. The United States entered a recession in 2001, exacerbated by the psychological blow of the September 11th attacks. The telecommunications sector was perhaps hit the hardest. During the boom, companies had laid miles of fiber optic cable across the world, anticipating a level of internet traffic that simply didn't exist yet. When the bubble burst, these companies were left with massive debts and unused infrastructure, leading to some of the largest bankruptcies in corporate history, including WorldCom. The losers were primarily retail investors who had moved their retirement funds into tech-heavy mutual funds at the peak. Thousands of tech workers in San Francisco and San Jose lost their jobs overnight as the venture capital market froze. However, amidst the ruins, the winners were those who had focused on building real utility and sustainable margins. Amazon saw its stock price drop by over 90%, but because Jeff Bezos had secured a massive loan just before the crash, the company had the liquidity to survive. Google, which remained private during the height of the mania, was able to grow quietly and efficiently by focusing on an actual revenue model through search advertising. These survivors proved that while the valuations were a lie, the technology itself was truly revolutionary. The outcome of the dot-com bubble left a lasting scar on the financial world that took more than a decade to heal. It was not until 15 years later, in 2015, that the Nasdaq finally returned to its March 2000 peak. The crisis forced a return to economic fundamentals. Investors rediscovered the importance of free cash flow and the necessity of a path to profitability. The regulatory landscape also changed, with the Sarbanes-Oxley Act of 2002 being passed to improve corporate governance and prevent the kind of accounting fraud that had become common during the era of easy money. The most significant long-term consequence, however, was a deep-seated skepticism toward technology stocks that lasted for years, arguably allowing companies like Facebook and Netflix to grow without the same level of early-stage public market interference. The destruction of $5 trillion in paper wealth taught the world that a great idea is not the same thing as a great business. While the internet did eventually change every aspect of our lives, the path to that transformation was littered with the remains of companies that mistook hype for value. The ultimate lesson of the 1990s is that human psychology is the one thing that never changes in economics. Whether it is the railway mania of the 1800s or the cryptocurrency and SPACI craze of the early 2020s, the pattern remains the same. A new technology creates genuine excitement, which leads to cheap capital, which fuels irrational exuberance, and finally results in a painful correction. For the modern investor, the takeaway is clear: never ignore the unit economics of a business. If a company loses money on every customer it acquires, growing larger only means losing money faster. Diversification is not just a suggestion, it is a survival strategy for when an entire sector decides to ignore reality. As we move further into the age of artificial intelligence, we must ask ourselves if we are seeing the same patterns emerge once again. Are we investing in the utility of the future, Or are we simply buying the next version of a sock puppet? Let me know your thoughts in the comments on whether you think we are currently in a new tech bubble or if this time really is different. The bottom line is that while markets can stay irrational longer than you can stay solvent, they always, eventually, return to the truth. This video is for educational purposes only and should not be considered financial advice. Always do your own research and consult with a qualified financial advisor before making investment decisions.